everyone, hope you're doing well. In today's deep dive, we are going to provide a big picture overview of where we're at in the market, and then we'll talk about 2 to 3 things that John is keeping a close eye on as we move in through the end of the third quarter here and into the fourth quarter. But before we do that, John, how you doing today?
Hard to believe we're saying into the third quarter, into the fourth quarter already. I can't believe this year has done that, but it's been a strange year to say the least.
Yeah.
A lot of things happening in the market, but yeah, doing well. Looking forward. Actually, took a couple days off around Labor Day, but that's still 2 weeks away. So such is life.
Such is life. Got a lot of ground to cover till we get there. So
Right.
that is true. So hey, let's get into it. We will have a chart inserted here in the body of this email. We'll also put it up on the screen. But in the last 4 to 6 weeks, we've seen a big, strong market rally, and that was in large part as a relief rally. We saw a huge amount of downside early in the year as the Federal Reserve began raising interest rates to combat inflation. And in the last few weeks, we've seen the market bounce back. And as I'm sure many of you are aware, we took advantage of that to do a good rebalance right around August 4th. And since then, we've seen strong outperformance of our equity models, and we've been very pleased with how they have held up. And so, John, when you think about the last 4 to 6 weeks of the market and of how we're positioned right now, what are some overall thoughts that you have?
It's interesting because a lot of times we always look at the market to say what's driving it. Long term, it ultimately revolves around profits of companies and long-term growth of broad-based economy. Short term, it's really about volume. It's about there being more buyers than what there is sellers. And so whenever we look at the first 6 months of the year, it was interesting. Through the downturn of January through the middle of June, there wasn't a whole bunch of extra volume. And so in other words, there wasn't a whole bunch of people running to the exit and selling. It's just that the buyers stepped away. And a lot of it has to do with the buyers stepping away because they want to find better prices to buy in at, cheaper prices to decrease risk. But why is that? That's because a lot of the uncertainty of not knowing what's going to happen with the Federal Reserve, with interest rates, a lot of speculation, but nothing set in stone. The last 4 to 6 weeks, well, let's even say from the middle of June, last 8 weeks, been a lot more clarity. We saw the Federal Reserve increase interest rates by 0.75% twice, and talks of just saying, hey, we're going to conquer this inflation deal, even if it puts us in a recession. So a lot of that just gave a little bit more security in the minds of investors. And they said, hey, we now know what the facts are. We can now make decisions. And hopefully it puts the stock market higher off the lows. And it's been a good position. Now, it's not rewarded every industry or every sector evenly. Certain ones have done better than others, and typically ones that are more of an inflation trade. And also, whenever we start to see interest rates rising, it does indicate certain areas that are going to go through cycles and go down faster. So across the board, we see some broad-based movement, but we also see some specialized moves in certain select areas.
So with that as context, when you think about just how we're positioning our client accounts right now, what are we trying to do with maybe the investments we're selecting or the amount of money we're holding in cash? What's our general thought on just positioning with some clarity, yes, but also possibly entering a little bit of an economic slowdown here?
Yeah, that's a great question. So as you all know, whenever we manage money, as far as looking at momentum, we're looking to assess, first of all, what is systemic risk? In other words, what's the risk within the system as a whole? And, we were 100% as far as net allocation, with up to 50% of the portfolio go to a broad market, which would be U.S.-based equities in the S&P 500, the NASDAQ, the Dow, Russell 2000, all those areas. And therefore, middle of June through the bottom, all the way through August 4th, that allocation was actually invested full on in the market because we had strong momentum heading to the upside. Now, where we go as far as in our rotation based upon momentum, we saw a real shifting. And, some of the areas we saw shifting really has to do with pace of upward movement. So if you can kind of envision, let's say the dashboard on your car, you have the speedometer, which shows you your speed. And depending upon the vehicle that you have, it might go up to 170 or it might go up to 85. Or if you drive one of the vehicles I was in last week, it probably went as high as 45. But, that shows your straight line speed. But then also you're gauging your RPMs, right, in the tachometer. And so that shows the kind of that pace of speed change. And so what we're doing is we're actually evaluating all the different industries and all the sectors to say which ones are moving up at the fastest pace. And Drew, it's one of those things we have seen a strong momentum shift really to areas that do better heading into a recession. Now, there are some areas which are a little more, I want to say, driven on political events, such as natural gas. But across the board, we've seen a strong shifting into natural gas, clean energy, which got a little bit of wind in its sails from the passage of the Inflation Reduction Act, which has about half of the dollars paid to clean energy, actually. And then also, as far as the utilities, micro caps and value play. And so those are the areas leading the market. That's where we have strong allocation right now across all portfolios.
And we've been very pleased with how those positions have held up. And John, is it safe to say that people would maybe look at that and say, hey, you guys have some money in cash, you have maybe some traditional recession areas that tend to do better in the portfolio. Is it safe to say we're defensive, or are we ever defensive?
I would say we're always opportunistic. And so within every market, it's not to say to get defensive or not, or be more offensive. It's truly to say where are the opportunities present. Now, sometimes the best opportunity really is cash. So a great example of that, we saw a strong uptick since June 15th all the way through August 4th in the broad-based market. We felt there was better opportunities down the line there, and so we ended up moving, at that time it was about 12.5, 15% over to the cash side. Well, does that mean we're getting more defensive? No. What that says is we believe there's some better long-term opportunities coming down the road, and we just want to position in cash to take advantage of the opportunities. And so that's kind of how we're starting to position that. I will say, though, whenever you go through different cycles, so in a recessionary cycle, let's say you look at banks, and when banks start setting more dollars aside for loan loss in their reserves, that's an indication that we need to maybe change our strategy a little bit because of the different players are going to be winners and different players losers. So a great example, do we like technology long term? The answer is yes. In this environment, though, we have to segment technology companies. So let's say we have technology inside your growth sleeve in your portfolio. We need to look at segmenting the technology to say, what are the companies that are really futuristic, that maybe don't have as good of a balance sheet, so they have higher debt, lower cash, and their sales have not ramped up completely, versus companies that are more legacy technology companies that have a very strong balance sheet, those that have a strong cash position and very little debt of the intermediate or long-term nature. Well, why is that? Because if we're going into an environment where the economy is slowing down, at the same time the Federal Reserve is raising interest rates, well, if someone has too much debt and not enough in sales and not enough in cash, they're in a weaker position. So it's about saying let's be opportunistic based upon what the environment is.
And so when you look 6 to 18 months down the line, I think it's probably safe to say that we're going to see some volatility in markets. We might see a continuing of slowing in the economic area, both here in the U.S. and definitely internationally. What are 2 to maybe 3 things that you're really keeping a close eye on as we move forward into the next 6 to 18 months?
Yeah, a lot of things we're looking at, it really has to do with home sales. It has to do with the employment and unemployment numbers. And so we know the Federal Reserve looks for an unemployment number, trying to track on that somewhere in that 3.5% range. We're below that right now. And so what happens as far as on the overall economy if we see more people get unemployed? We also want to look as far as the full integration, full actualization number of employment, which says what percentage of the workforce is actually working. So between 18 and 65, what percentage is actually working? That actually dipped down during and after COVID. So if that number stays lower, that's the indication the economy will be slowing. We simply also looking at things such as real estate. Are we seeing number of homes in inventory going up? Are we seeing days on market increasing? Those type of things do have underpinnings as far as the broad-based economy.
Yeah. Now, it sounds like we definitely have our fingers on the pulse. I know we do from all the data we track here internally. But when people are thinking about, hey, how do I take, as you just said, how do I take an opportunistic approach to the current environment and maybe to what's coming down the road? What are some things, some actual planning or investing or just best practices that people should be thinking about doing in the next few weeks and months here to really take advantage of what could be some opportunities down the line?
Yeah, I'll tell you a couple things that I think are just critical. Number one is I would take a step back and analyze your goal objectives, specifically time horizons of when you're planning on needing funds. That should give you a pretty good indicator of the level of risk that you should be taking. So the closer you are to needing the funds, the lesser amount of risk that you should be taking. Number two is I would encourage you to take a special assessment of your money, and we'll call it lazy money or safety money or money that is opportunistic cash. And if it's just sitting at the bank and you're earning a whopping 0.1%, you want to get that working a little bit harder into a tool or an account that's FDIC insured that is going to increase more whenever we see the Federal Reserve raising rates. And so you want to check out, we now have contracted with a group of banks, and we're able to give a very strong, high interest savings account. I believe it's paying 1.65% right now, Drew. And that has moved up almost in tandem within a day of the Federal Reserve increasing rates. So if they increase rates again, 0.75 coming up here in the next month, we should see that increase somewhere in that 2.3 to 2.4% range. So that's the second thing, is get your lazy money at work. The other biggie for so many people, Drew, is that if they're still working, they have so many dollars in their workplace retirement plans. A lot of those plans are just sitting. The number one investment vehicle, actually what's called a target date fund. We have seen across the board every single major provider of target date funds has drastically underperformed their benchmarks this year. And so we want to really assess that, really, and then also say what's your strategy if those dollars will work harder for you inside your 401k or 403b plan. And Drew, we have a couple solutions that make a lot of sense on that.
Yeah, we do. We have a couple currently available, and some that actually will be available here in the coming weeks. And so what we encourage you all to do is, if you have questions, one, just about your investments or how you're positioned, definitely reach out to us. But really begin thinking through those things that John just laid out. Every time where we go through volatility or through an economic slowdown, it's an opportunity to really take advantage of it to ensure that you continue on the path towards achieving your big financial goals. And so definitely reach out to us, whether it's on the cash solution or if it's on some retirement plan management. We'd love to chat with you about that. And so, John, I think we need to wrap it up here. We're getting close to our deadline. So what would just be one thought for us as we move forward here into the weeks ahead?
Yeah, is that every season, every environment, it really is an opportunity. And it's a matter of keeping your wits about you. And great poem, right, when we were in elementary school, but if you can keep your head when all about you're losing theirs and blaming it on you. In other words, if you can say there's opportunity on every corner, we need to simply be looking for it in the midst of uncertainty. Well, then you're able to find things. And I mean, a great example would be our strong play in natural gas. And we also know that as long as Russia and Ukraine, and we're heading to wintertime, and if that is not going to get resolved, we're going to see natural gas prices going higher. That's a tremendous opportunity. And so you have to say, let's look for opportunity in every single circumstance.
Yeah, absolutely. Well said. So hope you found this interesting. If you have any questions or you want to talk about some of those opportunities that we definitely think are in your best interest, reach out to us. We'd love to have that conversation with you and help you continue on your path towards achieving those goals. So thanks for your time, everyone, and have a good one.